Ready properties in JVC offer 7.8% yields immediately, but off-plan in Dubai South could deliver 15 to 20% appreciation. Which strategy wins in 2026? Here's your complete comparison. Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market, brought to you by Parag Kundalwal, founder and CEO of Consultaa, a Dubai-based real estate consulting and global capital advisory firm. Today is Tuesday, January 6th, 2026.
And on today's episode, secondary market versus off-plan. We're comparing ready properties and off-plan investments to help you choose the right strategy for 2026.
Let's dive right in. Lily, why don't you start us off with the secondary market? What are we talking about here?
Of course, the secondary market simply means completed, ready-to-occupy properties. The biggest advantage? Immediate rental income. You buy it, and you can start earning from day one.
And those numbers are compelling right now. In Jumeirah Village Circle, or JVC, ready properties are delivering average yields of 7.82%, with studios even hitting over 9%. And in Business Bay, you're looking at a solid 6 to 8%, with its proximity to the Metro and DIFC.
Exactly. Another key advantage is the physical inspection. You can walk through the property, assess the condition, check the finishes, and see the amenities with your own eyes before you commit. There's no construction risk, no surprises at handover.
That's a huge comfort factor for many investors. Plus, you're buying into established rental demand. These are proven tenant markets. JVC, for instance, recorded over 2,200 apartment transactions in 2025 alone. And Business Bay has the highest transaction liquidity in all of Dubai. You know people want to live there.
Absolutely. No construction delays, and you're buying into established infrastructure, operational schools, retail, healthcare, and transport links are already in place. It's a lower-risk, tangible investment.
All right, so that's the case for ready properties. Now let's flip the coin and talk about off-plan. This is where you buy a property before or during its construction, usually straight from the developer.
And the big draw here is leverage through payment plans. You can often control a full asset with just a 10 or 20% down payment. Think about an EMAR 10-70-20 plan. You could control a 5 million dirham asset with just 500,000 dirhams down.
That leverage is powerful. It also opens the door for significant appreciation during the construction period. We're seeing this right now in Dubai South, where properties have appreciated 15 to 20% just since the airport expansion announcement. Creek Harbour is another one, with 10 to 15% potential as it develops into what many call Downtown 2.0.
And you get in at a better price. The pre-launch and launch day pricing is typically 10 to 20% below what the market rate will be post-launch. For Q1 2026, investors should be watching for launches from Emaar Oasis, Nakhil's Dubai Islands, and Damac Lagoons for those early bird opportunities.
It's also a more accessible entry point. An off-plan unit in Dubai South can start from around 800,000 dirhams. That's often more accessible than an equivalent ready property in a more established central area.
Okay, so we have immediate income on one side and appreciation potential on the other. But how do the actual prices compare in 2026, Daniel?
That's where it gets interesting. Historically, off-plan was always priced 15 to 25% below a similar ready property. But in 2026, that gap is narrowing. We have about 64,000 new units being delivered this year, which is putting supply pressure on the mid-market ready properties. Sellers are becoming more negotiable.
So a ready property might not be as expensive compared to its off-plan counterpart as it once was.
Precisely. Let's take that JVC example again. A ready studio might cost 687,000 dirhams, giving you that immediate 9% yield. A comparable off-plan studio in the same area could be priced between 650,000 and 700,000 dirhams. But you have to wait 24 to 36 months for it to be completed.
And that wait time is a crucial factor when we talk about rental yields. A ready property starts generating income immediately. It's not just about the final yield percentage, but the time value of that money.
You've hit on the key point. A ready property earning, say, 7.8% annually for the 3 years an off-plan unit is under construction, generates a 23.4% cumulative return. For the off-plan investment to match that, it has to appreciate by more than 23.4% during construction, and then deliver a competitive yield once it's handed over.
Plus, there's a unique premium in January 2026. Corporate relocations spike at the start of the year, so ready properties can command a 5 to 10% rental premium for immediate move-in during this peak demand period.
So different strategies carry different risk-reward profiles. Let's break that down.
Ready properties are lower risk. You have immediate income, established demand, and no construction uncertainty. The trade-off is more limited appreciation potential, maybe 5 to 10% growth. It's best for income-focused investors who need immediate cash flow.
Off-plan is the opposite. Higher risk, construction delays are possible, developer selection is critical, and market conditions can shift. But the reward is higher appreciation potential, amplified by that payment plan leverage. This is for appreciation-focused investors with a longer time horizon.
And for 2026 specifically, that 64,000 unit supply pipeline is a major risk factor for the mid-market. It could pressure prices down by 10 to 15% in areas like JVC and Business Bay. For ready properties, you mitigate this by focusing on established buildings with high occupancy and metro links.
And for off-plan, you mitigate it by choosing top-tier developers like Emaar, Nakheel, or Shoba, and focusing on locations linked to new infrastructure, like the Metro Blue Line corridor or the Dubai South Airport Zone.
So for most investors, the answer isn't either-or, but rather a combination of both. How should they think about allocating their portfolio?
We generally recommend a 60-40 allocation for a balanced investor. That's 60% in ready properties for immediate rental income and stability, and 40% in off-plan for that appreciation potential and leverage.
Let's put some numbers to that. With a 5 million dirham portfolio, that would be 3 million in ready properties, generating around 180,000 to 240,000 dirhams annually. The other 2 million would go into off-plan projects in places like Dubai South, targeting that 10 to 20% appreciation.
Exactly. Of course, you can adjust that. An income-focused investor, perhaps a retiree, might go 70-30 towards ready properties. A younger investor with a long time horizon might flip that to 30-70, focusing on growth.
Let's bring it all together with a direct case study. JVC Ready versus Dubai South off-plan.
Okay, the JVC Ready Studio. 687,000 dirhams. It provides immediate income of about 53,700 dirhams a year. It's in a mature, metro-linked community. Now the Dubai South off-plan apartment. 800,000 dirhams. You put 10% down, so 80,000 dirhams, with payments spread over the 2 to 3 year construction. You're targeting 15 to 20% appreciation by the time it's handed over in 2028 or 2029.
So over 3 years, the JVC property would have generated over 161,000 in rent, plus maybe 5 to 8% in price appreciation. A total return of around 28 to 31% on your initial investment.
Meanwhile, the Dubai South property would have seen 15 to 20% appreciation on paper. That's 120,000 to 160,000 dirhams. But you haven't earned any rental income yet. The JVC property offers immediate cash flow and lower risk. Dubai South offers higher potential growth but requires patience and carries more risk.
So let's summarize the key takeaways for our listeners today.
Ready properties are the clear winner for immediate income, inspection confidence, and proven demand. Off-plan wins for appreciation potential, payment plan leverage, and getting in at early bird prices.
For most investors in 2026, a balanced portfolio allocation, like 60% ready and 40% off-plan, is the most prudent approach. It balances income, growth, and risk.
And remember those January opportunities. Capture the corporate relocation premium with ready properties and capitalize on Q1 developer launches with early bird pricing for off-plan.
Given the market context of 64,000 new units, be selective. For ready, focus on established buildings with high occupancy. For off-plan, stick with top-tier developers in infrastructure-driven locations.
That's today's Dubai Daily. The best strategy truly combines both ready and off-plan investments with an allocation that has to match your personal income needs, risk tolerance, and time horizon. For personalized portfolio allocation and to access exclusive property opportunities, reach out to me, Parag Kundalwal, at Consultaa. You can contact me via phone and WhatsApp at +971 585 964 631. Email me at parag@consultedxb.com. Visit our website at consultedxb.com. You can also connect with me on LinkedIn under Parag Kundalwal and follow us on Instagram at Consultant Now. Dubai Daily airs Monday to Friday at 7 a.m. Dubai time. Subscribe for your daily dose of Dubai real estate intelligence.